My dear students, welcome back to our channel. In this video, I will be explaining the BBA 5th semester subject Financial Markets and Services as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 4 first important short question is: define credit rating. Credit rating is an assessment of how safe or risky it is to lend money to a company, bank, or government. In simple words, it tells lenders and investors whether the borrower can repay their debt on time. Credit rating is given by credit rating agencies like CRISIL, ICRA, CARE, or Fitch. They assign grades like AA, A, BB to indicate the level of risk. AA, highest safety, very low risk of default. BB, moderate or higher risk. Easy example. A bank wants to lend 5 crore rupees to a new company. Before lending, it checks the company's credit rating. If the company has a AA rating, the bank knows it is very safe to lend. If the rating is BB, the bank knows the risk is higher and may charge more interest. Easy way to remember. Credit rating is equal to safety report for borrowing money. High rating safe to lend. Low rating risky to lend. Credit ratings help investors, banks, and companies make smart financial decisions, reduce losses, and maintain trust in the market. Next important short question is: 2. Merchant banking definition and features. Definition. Merchant banking is a type of financial service that helps companies raise money, manage investments, and plan financial strategies. In simple words, a merchant banker acts as a financial advisor and service provider for businesses, especially for raising funds through shares, debentures, or loans. Easy example. A company wants to raise 50 crore rupees to expand its business. A merchant bank guides the company on issuing shares, attracting investors, and completing all legal formalities. They may also manage the investment process and advise on mergers or acquisitions. Features of merchant banking. 1. Financial advisory services. Helps companies plan funding, investments, and financial decisions. 2. Fundraising. Assists in issuing shares, debentures, or loans. 3. Specialized services. Provides underwriting, portfolio management, and corporate planning. 4. Professional expertise. Staff includes finance experts, lawyers, and accountants. 5. Targeted for corporates. Services are mainly for businesses and large companies, not individuals. Easy way to remember. Merchant banker is equal to company's money guide plus fund helper plus advisor. Merchant banking is very important in India because it helps businesses grow, attracts investors, and ensures smooth financial operations. Next unit 4. Long questions. First important long question is: non-fund-based financial services. Definition. Non-fund-based financial services are services provided by financial institutions where no actual money is lent or invested. Instead, the financial institution provides guarantees, advice, or risk management, helping businesses raise funds or manage their financial operations. These services are mainly off-balance sheet, meaning they do not involve direct cash outflow from the institution. In simple words, non-fund-based services is equal to help without giving money directly. Examples of non-fund-based services. 1. Credit rating. Financial institutions or rating agencies evaluate how safe it is to lend money to a company. Example, CRISIL gives a AA rating to a company, showing it is safe for investors. 2. Letter of credit (LC). Banks issue a guarantee to pay a seller on behalf of the buyer. Example, an importer in India buys goods from Germany. The Indian bank guarantees payment to the German seller, ensuring smooth trade. 3. Bank guarantees. The bank promises to pay the lender if the company defaults. Example, a construction company takes a bank guarantee to bid for a government project. 4. Factoring and forfaiting. Institutions help businesses manage their receivables without providing direct loans. Example, a manufacturer sells goods on credit and uses factoring to get cash from a financial firm immediately. 5. Merchant banking. Helps companies raise funds, issue shares, or manage financial planning without directly giving loans. Key features. No direct lending of money. Reduces financial risk for businesses. Provides trust and credibility in trade. Helps businesses raise funds efficiently. Mainly targeted for corporates and industries, not individual customers. Easy way to remember. Think of non-fund-based services as helping hands without cash. Advice, guarantees, ratings, or risk management. They support businesses without giving money upfront. In short, non-fund-based financial services are vital for Indian businesses, especially startups and exporters. They reduce risk, improve credibility, and facilitate smooth operations without the financial institution having to spend money directly. This makes trade and investment safer, faster, and more efficient. Next important long question is: 2. Define factoring. Explain its functions and its modus operandi. Definition. Factoring is a financial service where a company sells its accounts receivable, invoices, to a financial institution, called a factor, at a discount to get immediate cash. In simple words, factoring helps businesses convert credit sales into instant cash. Factoring is very useful for businesses that sell goods on credit but need working capital quickly. Functions of factoring. 1. Financing function. The factor gives immediate cash to the company against its receivables, improving liquidity. 2. Collection function. The factor collects payments from the company's customers on behalf of the business. 3. Credit risk protection. The factor may assume the risk if the customer fails to pay, non-recourse factoring. 4. Advisory function. Factors provide advice on credit management, customer creditworthiness, and financial planning. 5. Accounting and record keeping. Factors maintain detailed records of receivables and collections, helping businesses focus on operations. Modus operandi, how factoring works. 1. Agreement. The business enters into a factoring agreement with a factor. 2. Assignment of receivables. The company sells its credit invoices to the factor. 3. Advance payment. The factor immediately pays a percentage, usually 70–90% of the invoice value. 4. Collection. The factor collects payment directly from the company's customers when invoices are due. 5. Final settlement. After receiving payment from customers, the factor pays the remaining amount to the company minus their service charges or discount. Easy example. A manufacturer sells goods worth 10 lakh rupees on credit to a retailer. The manufacturer needs cash urgently, so he sells the invoice to a factoring company. The factor pays 8 lakh rupees immediately. Later, when the retailer pays 10 lakh rupees, the factor gives the remaining 1.8 lakh rupees after deducting fees. Easy way to remember. Factoring is equal to sell receivables, get cash, factor collects payment, reduce risk. Factoring helps Indian businesses maintain cash flow, reduce credit risk, and focus on growth without waiting for customer payments. Next important long question is 3. What is forfaiting? Explain advantages and disadvantages of forfaiting. Definition: forfaiting is a financial service where a business selling goods on export credit sells its medium or long-term receivables, promissory notes, bills of exchange, or letters of credit to a financial institution, called a forfeiter, at a discount. The exporter gets immediate cash and transfers all payment risk to the forfeiter. In simple words, forfaiting is equal to sell export receivables, get instant cash, no risk of default. It is mainly used in international trade, especially for large capital goods, machinery, or bulk shipments sold on deferred payment terms. Example: an Indian machinery manufacturer exports equipment worth $50,000 to a buyer in Germany on a 180-day credit. The manufacturer wants cash immediately. He sells the bill to a forfeiter at a discount. The forfeiter pays the manufacturer instantly and collects the payment from the buyer after 180 days. The manufacturer is now free from default risk. Advantages of forfaiting: 1. Immediate cash flow. The exporter receives cash immediately without waiting for the buyer to pay. 2. Eliminates credit risk. The forfeiter assumes the risk of non-payment, so the exporter is safe. 3. Simplifies accounting. Exporters' receivables are removed from the balance sheet, making financial management easier. 4. Improves competitiveness. Exporters can offer longer credit terms to buyers without worrying about risk. 5. Professional handling. Forfeiters handle collections and legal formalities in international trade. Disadvantages of forfaiting: 1. High cost. The forfeiter charges a discount rate, which can be expensive for the exporter. 2. Limited to large exports. Usually used for medium or long-term, high-value exports, not small transactions. 3. Loss of control. Exporter loses control over the collection process once the receivable is sold. Easy way to remember: forfaiting is equal to export receivables cash now plus risk gone. In short, forfaiting helps Indian exporters manage cash flow, reduce payment risk, and focus on business growth, especially for high-value international trade transactions. Next important long question is 4. Merchant banking mechanism. Definition recap: merchant banking is a financial service that helps companies raise funds, manage investments, and plan financial strategies. Unlike banks that primarily lend money, merchant banks advise, manage, and facilitate corporate finance activities. In simple words, merchant banking is equal to company's money guide plus fund helper plus financial advisor. Mechanism of merchant banking. The merchant banking process involves several steps to help a company raise funds or manage finances. 1. Project evaluation. The merchant banker evaluates the company's business plan, financial status, and growth potential. They determine whether the project is feasible and how much funds are needed. Example: a startup wants to raise 10 crore rupees for a new software project. The merchant banker studies the business plan and project's future revenue. 2. Fund-raising issue management. Merchant bankers help companies issue shares, debentures, or bonds to raise money from investors. They guide the company on pricing, timing, and compliance with regulations. Example: a company plans an IPO. The merchant banker manages the process of issuing shares to the public, ensuring legal and regulatory compliance. 3. Underwriting. The merchant banker may guarantee the subscription of shares or debentures. If investors don't buy all shares, the banker buys the rest. This ensures the company gets the full amount of funds. 4. Portfolio and financial advisory. They provide advice on mergers, acquisitions, and investment strategies. Helps companies optimize returns and reduce risks. Example: a company wants to merge with another firm. The merchant banker advises on valuation, negotiation, and legal formalities. 5. Post-issue services. Merchant bankers assist in listing securities on the stock exchange. They also monitor investor relations and market performance of issued shares. Easy way to remember mechanism. EFUPP. E. Evaluate project. F. Fund-raising issue management. U. Underwriting. P. Portfolio advisory. P. Post-issue services. In short, merchant banking in India acts as a one-stop financial service provider for companies. It evaluates projects, raises funds, underwrites securities, advises on investments, and ensures smooth financial operations, making corporate growth faster, safer, and more organized. Next important long question is 5. Merchant banking types. Merchant banking in India provides a variety of services to companies, and these services are categorized into different types based on the nature of assistance provided. Understanding the types helps businesses know which service suits their needs. 1. Issue management underwriting services. Merchant banks help companies raise funds by issuing shares, debentures, or bonds. They also underwrite the issue, meaning they buy any unsold shares to ensure the company gets the required funds. Example: a company planning an IPO wants to raise 50 crore rupees. The merchant bank manages the share issue, advises on pricing, and ensures all shares are sold. 2. Portfolio management services, PMS. Merchant bankers manage investments of companies or high-net-worth individuals to maximize returns and reduce risks. They decide which stocks, bonds, or assets to invest in based on financial goals. Example: a business has 5 crore rupees to invest. The merchant banker suggests a mix of stocks, debentures, and mutual funds to achieve safe growth. 3. Advisory services. They provide expert advice on mergers, acquisitions, takeovers, financial restructuring, and business expansion. Helps companies make strategic financial decisions. Example: a company plans to merge with another firm. The merchant banker advises on valuation, negotiation, and regulatory approvals. 4. Loan syndication. Merchant bankers arrange large loans from multiple banks for companies. This is useful when a single bank cannot provide the full loan amount. Example: an infrastructure company needs 200 crore rupees. The merchant banker arranges multiple banks to provide portions of the loan. 5. Project counseling and feasibility studies. They assist in evaluating new projects, preparing feasibility reports, and estimating costs and returns. Ensures that the project is financially viable before starting. Example: a startup wants to build a solar plant. The merchant banker evaluates costs, revenue projections, and financing options. Easy way to remember. IPALP. I. Issue management underwriting. P. Portfolio management. A. Advisory services. L. Loan syndication. P. Project counseling. In short, merchant banking is not just about raising funds. It guides, manages, and protects corporate finances, helping Indian companies grow, invest wisely, and handle complex financial operations efficiently.